Don't invest in the IPO for Kenya Pipeline Corporation. The reason I say that is because the price per share is 9 shillings. And with a dividend yield of 4% per annum, what that basically means is you will be getting 4% of 9 shillings every year, at least for the next few years, as your return for the year. So if you look at 4% of 9 shillings, we are talking about you getting 36 cents, not even 50 cents, for one share that you are buying at 9 shillings. A return of 4%, basically, it is very clear, it is all over, it is in their website that the dividend yield is 3.9%, which I'm calling 4%. And what that means, dividend yield, is computed by getting a ratio of the dividend per share divided by the market price of that share. Of course, multiplied by 100. So you'll be getting 4%. So for one share that you are buying at 9 shillings, then the value of the return is 36 cents. And I tell you this, these shares are overvalued, and never invest in a share that is overvalued. Why is it overvalued? The reason I'm saying it's overvalued because we can look at the second statistics, and this is price earning ratio, a price earning ratio of 21. What price earning ratio of 21 means is that, remember, I've told you that for 9 shillings, you will be getting 36 cents as your return. But what if you want to get 1 shilling as your return? That figure or that answer, we get it from the price earning ratio of this company. And these are statistics that the Kenya Power Corporation is putting in the open. It's about how do you interpret them. They are required to prepare and publish a prospectus, which they have. And a prospectus is a book that details what kind of a company is issuing an IPO, in which sector, in which industry does it operate, who are the key management personnel, what is the profitability for this company for the last few years, who are the competitors, what are the strengths, what are the weaknesses, what are the opportunities, what are the threats of this company. All is there. So the price earning ratio of 21, it means that for you to earn only 1 shilling, you need to invest 21 shillings. That is the reality of the matter. All of us are able to access this information, but how we interpret it is the difference. So for every 21 shillings that you invest, you will get a return of 1 shilling. And some people do say that when you invest in shares, your returns or your profit comes in 2 ways. Your profit comes in 2 ways. Number one, through what we call share price appreciation, that when you can buy a share at 9 shillings, then after some time, the price of this share goes to 15 shillings and you're happy because that is a gain. Or you can benefit by investing in shares through the dividend payout. So dividend payout we have discussed, it is 4%, meaning that you invest 100 shillings and what you get in a year is 4 shillings. Is that good enough? When the same government is asking you invest with us in treasury bills, in treasury bonds, and we will give you about 10% per annum as the return on investment. But now this is IPO, they are giving you 4%. And it's the same audience, same investors. But because this time around is something new, then it confuses most of us. It is 4%, and this is what you want to compare with what the government is offering for treasury bills and for treasury bonds. And for the record, treasury bills and treasury bonds are usually referred as risk-free assets. The reason they are referred as risk-free asset is because it is a debt, it is a promise that the government has given to you that when you buy our treasury bonds, our treasury bills, we will give you this rate of return at 10%. And if we don't have money as government, we will just issue more treasury bills and more treasury bonds, and the money that we'll see from subsequent issuances, we will pay you. And if the worst goes to worse, then we will do other Eurobonds. We will borrow from China, we'll borrow from Europe, we'll borrow from IMF, from World Bank, and if the worst comes to worst, we can even print more money. So that is, if the risk-free investment with the government is giving you 10%, what about KPC, Kenya Pipeline Corporation? And it is a share. For shares, you are never guaranteed anything. If the company makes losses during that year of income, you get zero. And there are times they can earn some good money. Like now, the earning for Kenya Power, for Kenya Pipeline Corporation, net profit is 19%. When it is 19%, that's what they have earned from actually something higher, which is called EBITDA. EBITDA is earning before interest, depreciation, and amortization. Basically, the operating profit of this company is about 50% because it is 48%. From operating profit margin of 48%, the net profit comes to 19%. From that net profit of 19%, they give you 4% as the dividend yield. So you only get 4 shillings for every 100 shillings that you have invested, 4 shillings. And for every 21 shillings that you have invested, you get 1 shilling as the return. And for every 1 share you buy at 9 shillings, you get a return of 36 cents. Compare that with a rate of return of 10%, 15%. At some point, the government does offer securities at a return of 10%. And more so, think about something like Mansa X, which is giving you a return of about 20%. And something like Quest Pinnacle, it is an investment firm that gives you a return of 16%. Then money market funds, they are giving you a return of about 10% and above. So why would you then want to commit your funds by investing in Kenya Pipeline Corporation, which I'm telling you this for sure. Let me tell you the reverse, because this information is given in the numbers that they have given to us. If the dividend yield is 4%, do you want to know how many years you will take before you recover your initial investment? If you are to hold on and don't sell your shares, you say, I will recover the price and the investment that I've done in these shares through the dividends. So if it is 4% per annum, simple mathematics, get 100%, divide by 4%, which you are getting per annum. If you do that, 100 divided by 4, 25 good years. It therefore means that 9 shilling that you are buying 1 share at, if you rely solely on dividends, and this we are saying ceteris paribus, that things don't change. And this is how we do it. You cannot predict the future. So the best you can talk about the future is to think that things will remain the way they are. Of course, they can go bad, they can become worse, they can become better. But for now, we say, let things remain the way they are. So you are getting 4 shillings for every 100 shillings that you will invest in Kenya Pipeline Corporation. That is 4%. So 100 divided by 4, it will take you 25 years. 25 years, let me ask you, if you're about 40 years like I am, it means that you will recover the 9 shillings when you are 65 years old. Because the 9 shillings, remember, I told you, the 9 shillings that you're investing per annum, you will be given 36 cents, not even 50 cents. 36 cents, because we are saying 4% of 9 shillings is 36 cents. If you divide 9 shillings by 36 cents, you will find it is 25 years. That is what is up for grabs for you. Do you want to take a chance? Do you want to think otherwise? For me, I don't want to influence you. It is you. I'm just trying to unpack what it is. So in summary, in short, the price is 9 shillings per share. In my thinking, that price is overvalued by far. The best price that these shares should be sold at is 5 shillings. And what will happen is once the IPO is done and dusted and we meet in the secondary market, those prices will not go up. You will see those prices coming to 8 shillings, 7 shillings, and 6.5 shillings. That is my word. And that will be losses to you. Remember, I said you can benefit by investing in shares through 2 ways. Through share price appreciation. This time around, shock on you, we are talking about share price depreciation, coming down. And the dividend that you are getting for investing in those shares, 4%, 4 shillings for every 100 shillings, and 1 shilling for every 21 shillings, and that's 6 cents for every 9 shillings that you invest. So the choice is on you. I have no problem with net profit. I have no problem. For me, the problem starts. The problem comes in regarding the share price, 9 shillings. If we were to say these shares will be sold at 5 shillings, for example, if we were to say that these shares will be sold at 5 shillings, for example, then my story changes completely. And I tell every Tom, Dick, and Harry, come, we buy these shares. Because the dividend yield would change from where it is around 4% to around 10%. And there at 10%, we are competing with money market products. We are competing with treasury bills, with treasury bonds. And we are also having and looking for the perspective of this share price moving from 5 with time to 6 to 7. But when it is at 9, I have a big problem with that. It can only come down because figures and mathematics don't lie. So if the price was to be from 9 to 5, then the dividend yield will change definitely. The price earning ratio would change from what you are saying that you need 21 shillings for you to get 1 shilling, and you would probably, instead of requiring 21 shillings to invest to get 1 shilling, you would require something like 10 shillings so that you would require to invest 10 shillings so that you get 1 shilling as a dividend, which is basically 10% as the return on investment. The other thing, remember I said that dividend yield is 4%. And dividend yield, how do we get to dividend yield? Dividend yield is basically, we say the dividend per share divided by per share. Dividend per share divided by price per share is what is giving us to 4%. So the dividend yield, if the price was to come down, the dividend yield would also go up. If the dividend yield would go up, what would mean is that the way I was saying that you are getting 4% per 4% as rate of return on investment for the money that you invest in there, the dividend yield would change from 4% to about 10% if the price was to come down from 9 to 5. With 10%, what that means, that you will be getting 10 shillings for every shillings that you invest. 10 shillings for every 100 shillings that you invest. That means if you say you will not sell your share, you will hold it until you recover these 100 shillings that you are investing, and you are getting 10 shillings per year. It is 100 shillings divided by 10 shillings. That makes it 10 years. That you will only require 10 years for you to recover your initial investment. But as it is, you require 21 years to recover what you will invest in Kenya Pipeline Corporation. Remember, even real estate, you require about 10 to 15 years to recover what you are investing. and it's something that you will benefit from for so many years. Once you do a building and the recovery rate is 15 years, the project recovery period is 15 years. Once 15 years are done, and remember the real estate is a low maintenance project, you will earn and benefit from this project for so long. So it is up to you whether you choose to invest in Kenya Pipeline Corporation. There are many better options that are still being given by the same government. But what you are supposed to look up to, for me, it is the price. This price is overvalued. If the price was to come down from 9 to 5, other statistics would change from what we are calling dividend yield to price earning ratio and to the time that you will need to recover your money. And by those statistics changing, this investment, this IPO, would compete aggressively against other existing investment options, and we would say it would be oversubscribed. But for now, it's a wait and see. When you know better, I expect you to do better.